starting. All attendees are in listen-only mode.
Hey everyone, we're just going to give another minute or two to allow more people to join. Hi everyone, I'm Jackie Smith with the Intentional Endowments Network. We welcome you to the Sustainable Investing for Hedge Funds webinar. All participants are currently on mute, and we encourage you to send questions via the chat function throughout the presentation, and we will compile them and get through as many as we can at the end for a moderated Q&A. The webinar will be recorded and then distributed to all registrants via email and will also be available on the IEN website under webinars. Today we'll be discussing an overview of sustainable investing in hedge funds, including sustainable themes, areas of opportunity, multi-manager portfolios, and active ownership through oversight and corporate engagement. We will have a range of perspectives presented on this topic, including DonnaSelva from Prime Buchholz and Associates, bringing the consultant point of view, Sam Sussman, partner and head of investment strategy and portfolio manager from Alternative Investment Group, to discuss why sustainable investing strategies are effective in hedge funds, and David Dinerman, trustee from Hampshire College, will review how it can be used in higher ed endowments. Before we dive into the presentation, some context about IEN is that we are a collaborative peer learning network advancing intentionally designed endowments. Our approach is to support endowments to learn from and collaborate with each other in finding the solutions that work for them at their own pace in accordance with their culture. We do this in 5 main ways. 1 is through forums and events. 2, by facilitating knowledge exchange. 3, by creating new resources when needed. 4, through education and capacity building, and 5, by promoting peer-to-peer networking and learning among endowment stakeholders. Now we will hear from DonnaSelva, who will be reviewing the landscape and where sustainable hedge funds can fit into a portfolio. Alice?
Today I'm going to talk about sustainable investment options from the consultant point of view and how we work with our clients. So sustainable investment options in the hedge fund space are growing but still remain limited. This leaves many of our institutional investors who seek sustainable investment options weighing the pros and cons of a hedge fund allocation. By and large, our clients have come down on the side of maintaining a hedge fund allocation despite the limited universe. In the next few minutes, I'll be talking about why they do that and also the creative ways in which they approach the space and what the options are for investors who want to seek sustainable investing in this asset class. Next slide. I think we missed one. Yep, just here, sorry. So the three main reasons are outlined here. Over extended periods of time, hedge funds offer equity-like returns with between a third and a half of the volatility of the equity markets. Further, hedge funds have had low correlations to the stock market and the bond market, and thus bring down the overall volatility of the endowment portfolio. Why is this important? It's important because institutional investors, endowments, and foundations are providing support for a variety of important programs that need for a more stable that need a more stable cash flow from year to year. For example, a community foundation has multiple grantees who are relying on it for a sustainable cash flow. Often when the markets decline is a time when donors also pull back, and so they rely on those foundations for that steady cash flow. That makes it important to keep volatility limited. Next slide. So in this slide we showed just the benefit of that portfolio. The blue line represents a portfolio that has 9.7% annualized return. It's a hypothetical portfolio, and a 9.1% annualized standard deviation. The green line represents an annualized return slightly higher, but more than twice as much volatility, or the standard deviation. So you can see over time that an endowment with a similar rate of return and lower volatility will end up at a better place. The growth of $1,000 leading to a 2.2 hundred and the other to 1.9. Next slide. Another reason to invest in hedge funds is the expanded tool set and the flexibility in terms of time frame. So, for example, for the tool set in a long-only public equity strategy, if you do not have high conviction in a manager, or you expect maybe fraudulent accounting that is misportraying profitability, you have no choice but just not to invest. With a long-short strategy, you can short that company and hopefully gain from the troubles and the shortcomings you see there. Additionally, many of the credit opportunities that we find in the markets take longer to play out. Hedge funds with their longer lockup period, a little bit less liquidity for their investors, have the opportunity to take advantage of those and to give up some, gain a better return from the liquidity, from the illiquidity. Next slide. So what's actually been the experience of hedge fund managers versus the markets? This table shows the HFRI Fund of Weighted Composite Index. That's a composite index of 2,000, equal weighted index of 2,000 hedge funds, direct only, no fund of funds, that have more than a year of return history, and these are net returns. So you can see on the left-hand side of the graph that they've captured about in up months. These hedge funds as a group capture about a little more than half of the return of the S&P, and in down months for the S&P index, they capture only about a quarter of that downturn. So that's how they protect on the downside, thus giving you that better return over the long period. Next slide. This slide simply shows the types of returns. The things to note there, if you look at the S&P 500 and the MSCI World ex-US, which is all other U.S. markets, developed U.S. markets outside the U.S., annualized return for January 1990 to December 2016 has been 9.4% after a very strong 7 years for the S&P market, for the S&P 500, and 4.6% for non-U.S. developed markets. That compares to returns of between, these are what shows below is all the different hedge fund strategies and how they're measured by the HFRI indexes. And they range between, those returns range between 6 and 11% approximately. They've provided those returns with standard deviation, or again volatility, of somewhere between 3 and 8% versus the 14 to 17% for the market. Next slide. This slide just alludes again to that correlation. The hedge fund, the last three lines, the fund of funds, and the two above it, equity hedge and market neutral, have generally been low correlated, correlations of around 50 to 60 basis points relative to the equity markets. So those are the reasons that our clients tend to still stick with a hedge fund allocation. It is that equity-like return, lower volatility, low correlation to the other asset classes in their portfolio, which brings down overall portfolio volatility and gives them a stable cash flow for their donees, grantees. Next slide. So what's going on in sustainable investing in hedge funds, and how are our clients who want to invest in a sustainable way allocating in a hedge fund space? So the current landscape for the hedge funds still remains limited, as I mentioned at the beginning of the call, especially for the types of hedge funds that our clients tend to look for, which is assets greater than 30 million, a return history of they usually look for 3 to 5 years, but what we've experienced so far is they generally have a year or two, especially in the fund of fund space. In the direct funds, there's options with longer history than that. That they still remain on, they generally remain on the smaller side in hedge fund terms. That can be a benefit, or it can have some downside. There's a few direct long-short managers focused on alternative energy and renewables. They may focus also on companies that they believe will benefit from consumer trends and sustainability. And there's also more managers now, growing number of managers that offer separate tranches that will exclude certain products or services. Some of those tend to be for faith-based investors. There's a few for that will eliminate fossil fuel freeze out of one, fossil fuel stocks out of one tranche. So the considerations, as I mentioned, the space is limited. So what do you do here? One option is to use these as a diversifier in a broader hedge fund portfolio. So as I mentioned, the HFRI universe is like 2,000 funds, not all of which are things we would invest in. But just to compare that to sustainable options, we see probably fewer than 50. Sam may be able to give a better idea of that in a few minutes as he surveys the space, but certainly ones with a longer history or more assets tend to be pretty limited. So what do? You take some of the direct long short if you have a well-developed hedge fund portfolio, and you add those as diversifiers is one option. You tend to look for managers. There are hedge fund managers that have a longer term focus in their long only positions. They look for the long term. Those managers with longer term investment horizons are more likely to consider climate change or other environmental and social risks, because those will impact the companies over the long term. They may not state that they do ESG investing, but they may consider some of the risks still. Another thing to consider is the lack of transparency. So that's been another trial for sustainable investors who invest in hedge funds. We have found that there are a few managers are putting greater emphasis on transparency. We get quite a bit of transparency as a consultant, and so we share that with our clients. Most of our hedge funds, I would say the majority of them, are willing and able to respond to questions about exposure to certain industries or certain specific list of companies on a quarter lag. The costs of those hedge funds that are available are comparable, so there's no real cost give up in the hedge fund space. It's pretty comparable to the broad mainstream hedge funds are comparable to the sustainable investment options. So just as a takeaway to add to that, we have looked at our recommended managers in this space, and I would say, and what we do is we review what their ESG policies are. Most of them fall into the camp of either having little or no interest in ESG investing, or is really seeing ESG as a risk to consider, not necessarily something that would recommend holding it or not recommend holding it, but a risk to think about when they're weighing their investment decision. Next slide. So what can you do? As I mentioned earlier, there's a few opportunistic investments that can be added to a well-diversified hedge fund portfolio. We've also had clients who consider including alternative investments, not hedge funds, but that they act like hedge funds in their return and risk profile, or they're expected to, and they may be included in their hedge fund portfolio. And lastly, and I think the part that gets overlooked and is probably the most important, is to plan for this to be the last part of the portfolio. Don't just say, oh, well, we can't do it in hedge funds, so we're not going to do any sustainable investing. You do the other asset classes first. Keep an eye on this space. Investigate what's available. Continue to monitor that universe, and also you can impact the growth in the universe. So I think investors have had a huge impact on equity, and especially equity managers, and to some extent fixed income managers, just by asking whether they consider ESG factors and just by pushing them. So we know we don't often get the question anymore, ES what? Most of the managers know what it is. They are curious about it. We've shared some of the Harvard reports with some of our hedge fund managers. So I think it's just a matter of showing that there's a demand there and asking the questions. So one of the questions that you can ask them is just to note that soft assets, intangible asset value in 2015 makes up 84% of the value of a company, as opposed to 17% back in 1975. So you want to know what's impacting those intangible assets. So they play an increasing role in creating shareholder value, and that's something that you can ask your hedge fund manager. How are they looking at the value of those intangibles? How are they looking at the way social capital and natural capital and the way the companies treat that and how they impact that value? So Sam can give you much greater detail on that as he talks about how he's seeing the benefits of ESG analysis in hedge fund investing.
Great, thank you, Alice. Hello, everybody on the call. This is Sam Sussman from Alternative Investment Group. We're an investment firm that's been managing fund of hedge funds for over 20 years. We have about $1 billion under management, and we manage a fund that has a focus on sustainable and ESG strategies. Now, similar to Alice, what we found when speaking with clients is that there's a widespread utilization of sustainable and ESG investing in asset classes like long-only equities, in bonds through green bonds, in impact-oriented private investments, but there seems to be a lot less consideration given to this approach in hedge funds. Now, it takes a lot of work to identify the managers that are truly integrating these principles into their investment strategy, but we're seeing the universe of sustainable and ESG managers growing, and our view is that there are a lot of benefits to this type of hedge fund investing. A lot of people ask if there's going to be a return give up. Well, our view is not only is there not a return give up, but because of the certain attributes of sustainable and ESG sectors, there's the potential to actually deliver better returns than non-ESG counterparts. So what are those benefits and attributes of sustainable and ESG investing? Well, we think there are 5 things to think about and consider. Number one, first, we'll address the most common hedge fund strategy, which is long-short equity. So in long-short equity, one of the key ways managers generate performance is from the return differential between their longs and shorts. They're looking to go long winning companies and short the losers. And so what determines the quality of the opportunity set is how much stock dispersion there is, or the spread between the winners and losers. And that tells you how much potential there is to add value. And if we look at sustainable themed long-short managers, these are managers focusing on areas like renewable energy, like global healthcare solutions. And these are areas of the equity market with the greatest stock dispersion. So Jackie, can we move to the next slide? So what this shows is the stock dispersion by sector. And you can see sectors that have sustainable themes like healthcare or renewable energy or certain areas of technology are the areas of the equity market with the most stock dispersion. So let's look at renewable energy, or energy, which includes renewable energy. The stock dispersion there is 94%. That means the winners outperform the losers by 94%. And this is the 90th percentile versus the 10th percentile. So how we get that number, it means that the winning stocks on average in the top 10 percentile are up, maybe 60%, and the bottom 10 percentile is down 34%. And that's how you get that 94% number. And so the sectors around sustainability are the sectors with the greatest dispersion, which creates the greatest opportunity for long-short managers. In addition, sustainable business models are natural drivers of dispersion because they're often industry disruptors. Now, what we're looking for are managers that are going long the companies that are solving global problems around sustainability, and they're shorting the losers. So what are some examples of this? Well, we've had managers that invest long in the winning technologies in renewable energy and short losing coal companies to capture that performance differential. So one manager, for instance, owns NextEra Energy. That's an electric utility company that's successfully been transitioning to cleaner energy sources, such as wind and solar. In fact, NextEra generates more energy from wind and sun than any other company in the world. And their share price has more than doubled over the last 5 years. And on the other end of the spectrum, more than half of the assets in the coal industry are held by companies that are in bankruptcy or don't earn enough to pay their interest. So this is an example of a great area for long-short investing. And we've identified a number of high-quality managers that are employing sustainable themes in these very high dispersion areas. The second thing to consider around sustainable and ESG hedge fund investing is that there's a lot of volatility in areas around sustainability. Many of these areas are driven by a complex mix of factors: regulatory policy, commodity prices, technological innovation, and that can bring a lot of uncertainty and a lot of volatility. Jackie, can we move to the next slide? So you can see on this slide that the Wilder Hill Index of clean energy companies, which is the top line, is more than twice as volatile as the S&P index. Now, this volatility tends to be very good for active strategies like hedge funds because it provides multiple entry and exit points for investments. Now, at the same time, it can make it particularly hard for long-only strategies, since it can lead to significant drawdowns, and it could be hard to stick with an investment through the volatility. Anybody who had long-only investments in renewable energy in July of 2015 went through a very challenging time with the collapse of the Sun-Edison complex. So if you have the ability to short to reduce that volatility, the way Alice showed a number of her exhibits, that's very important for many investors, and at the same time, it can be a great source of return potential. This is also why we think multi-manager portfolios that integrate a diverse set of sustainable and ESG approaches make a lot of sense, instead of a concentrated exposure to one area within sustainability. The third point around sustainable and ESG investing is that academic literature continues to support the thesis that companies with more sustainable practices see their stocks do better. Can we have the next slide, Jackie? I think Alice maybe was referring to this study, and you could see on the slide the conclusion from this Harvard Business School study, which shows just that. And the study went on to show that top decile performers on ESG metrics see their stocks outperform the bottom decile by about 3% per year. So there's a real impact in the equity market performance. Now, this isn't completely surprising. I think those of us on the call probably agree that companies that are more forward-thinking about ESG issues tend to be better managed in other aspects of their business. Just look at Apple. In a shareholder meeting, Tim Cook, Apple's CEO, described his concern about climate change and what the company is doing about it. Now, what they're doing about it is they use 100% renewable energy to power their data centers, and they struck an enormous $850 million agreement to buy solar power to run their California operations. And on that call, he told investors who only care about profits to get out of the stock. Now, it's not that Tim Cook isn't concerned about profits. I think we all know Tim Cook is very concerned about profits. But the point is that companies like Apple understand they need to consider all of their stakeholders, and those companies tend to perform best. Now, Apple stock, by the way, is up 20% so far in 2017, with the S&P up 5.5%. Now, the other benefit in evaluating a company from an ESG perspective is we think it can give an analyst a competitive edge, because not everybody is looking at things this way. So we've identified a great group of hedge funds that incorporate ESG into their investment strategy. Now, where are they getting their information? You know, some are using services like MSCI or Sustainalytics for their research. Others are getting the information independently. And it's not just on the long side. Looking at companies from an ESG standpoint is very effective on the short side to identify hidden risks. Companies that may face real liabilities or just have unsustainable business models. You know, one manager that we work with was shorting some of the pharmaceutical companies whose business models relied on continuous and unjustified price increases, which turned out to be a very effective short when that practice was called into question. The fourth point to think about in sustainable and ESG hedge fund investing is that while long-short is a very effective way to express views on sustainability, there are also a variety of credit strategies that we think are just as appropriate. Jackie, can you turn to the next one? These strategies are about expanding access to credit to help build communities and support small businesses. One example is mortgage credit, which has become overly restrictive post-financial crisis. So even solid middle-class borrowers may have a hard time getting a mortgage. There are mortgage strategies that provide credit access to those borrowers who are good credit risks. They're not the old subprime, but they might not meet today's stringent standards. In other areas of the credit market, like the municipal space, certain schools and hospitals may have run into a credit issue, and managers can provide a needed loan to tide over the institution and help them repair their balance sheet. Small business loans that support community development are another important area. Now, the returns from these strategies can often be superior to other credit strategies because it takes more work to analyze these borrowers, and so the market will reward you often with better returns. And from a portfolio construction standpoint, these strategies can be a very useful diversifier, since their returns tend to be idiosyncratic and not related to the direction of equity markets. We've seen a lot of growth in these types of sustainable-oriented credit hedge funds. The last point I want to make is about having a fossil fuel-free portfolio. Now, clearly, this aligns with a sustainable long-term investment approach. Now, some people have argued that it will lead to long-term underperformance. Actually, if you look over a long time horizon, and Jackie, can we get the next slide? You can see that a fossil fuel-free index has outperformed the S&P. Now, that may not always be the case, and there are likely to be some short-term periods when it will underperform. But our view is not as much about the short-term performance gyrations, but about the long-term climate change-related tail risks. Given the real threat of climate change, there's a significant possibility that some action, like a carbon tax, will be enacted, which will be very detrimental to these stocks. In addition, we're already seeing the risk of stranded assets, assets that a company has on its balance sheet that become too expensive to extract because of changes in commodity prices, because of changes in regulation or competition. Exxon just wrote down 19% of their reserves that were no longer economically viable. So we believe it makes economic sense to have a carbon-free portfolio given the risks. So in conclusion, I'd say we're excited about the opportunities in sustainable and ESG hedge fund investing because we think it's possible to invest in line with your values and at the same time get an edge in generating returns. So I'll now turn it over to David Dinerman, who is a trustee at Hampshire College, and they've really been a leader in sustainable investing.
Hello, everybody. Hampshire, for those of you who are unfamiliar with it, has been a long-time thought leader in this space. Hampshire was one of the early institutional investors to divest from South Africa, and took the direction in 2011 to do an overtly and directly ESG-driven investment policy. Over time, and that has, as you might imagine, that has its complexities because of defining what is ESG and to what extent a particular investment complies with those issues, those directives is a challenge and a consideration. Hampshire's endowment is a relatively small one. We're under $50 million. As a result, we don't do a lot of direct investing. Rather, we invest at the manager level. So a lot of our work is done by picking managers that align with and understand and work within the constraints and directives of our policy. Because we have a small endowment, we're also very conscious about trying to grow it so that we can sustain and support the mission of the college, which is education. And as a result, we are a bit equity heavy. And one of the results of that, and one of the values that we see with hedge funds, is that, as Alice and Sam have discussed, it helps reduce some of the volatility that's associated with that. So we were very fortunate to run into AIG and have used them as one of our managers. One of the things that is also a real consideration for us and very important to us is that because we are a not-for-profit institution, we think that there's a very important dimension, both internally and externally, to be transparent about what we do with our endowment. As a result, after being asked to do so by some students, we have made a commit and are acting on that commit to report quarterly on what we own. Initially, that's fairly easy and straightforward on the pure equity and on the fixed income investments that we have, but that was a bit of a challenge in the hedge fund space. But we have worked with our managers and with our advisors and have actually gotten some fairly good transparency, mostly on the long side in the hedge fund space. We think that's an element of governance that aligns with our policy and aligns with our mission. So having hedge fund managers that are willing to work along those lines, to us, is both intellectually consistent and important. We also are of the mind that this kind of investing, as Sam has suggested, helps manage risks and helps us be consistent with our academic mission and with our investment policy, which we really try to be part of a broader-based intellectual consistency across the campus. For example, one of the things that we're doing at the college is we are in the final stages of implementing a large solar field so that we can be carbon neutral by 2020, which is a commitment we've announced to the world. Having hedge funds as part of that, obviously, like I said, it helps us reduce volatility, helps us manage and try to grow the endowment as quickly as we can. And what's been interesting for us is that there is an increasing arena of managers that are willing to participate along these lines, and we think that that's been tremendously helpful. And it's sort of, we think that there's a sea change going on in the investment world, that people are taking ESG investing far more seriously and are using it, again, as Sam suggested, as at least a factor, if not a screen, on how to think about where to invest. I think that's particularly true for not-for-profits because of their need and need to deal on a multi-generational basis, and therefore not be quite so tied to quarter-to-quarter returns, and rather to look at intergenerational neutrality, which is an emerging concept on the fiduciary side, and that again, hedge funds help us look at it that way and address those issues in a way that reduces volatility and helps us sustain the returns as we try to grow the endowment.
Great. Thank you, Alice, Sam, and David. Now we will begin the moderated Q&A. Okay, our first question is for Alice. How many direct long-short managers that you cover are focusing on clean energy, and are these dedicated funds, or is clean energy part of the strategy?
Thanks, Jackie. We have right now one manager that we've approved that's focused on clean energy. As I would say, they also have some other themes in the portfolio, but clean energy is definitely a significant portion. Another that we're looking at, and a few within a fund-to-fund structure that we are currently diligencing. We have looked at others and haven't been able to get comfortable with them, so that's where we are right now. We do see some exposure to yieldcos and wind energy companies in some of our what we call our traditional managers, but I wouldn't say it's an area of focus for any of them.
Thank you. Okay, and this next one is for David. How to respond to student calls for fossil fuel divestment from the endowment within the hedge fund space? Do you have any suggestions?
Yes, there's really two. One is, actually three. One is that one of the things that we've done, and this actually came up in the context, I'll tell a brief story. We had a group, the Black Lives Matter students on campus approached us, and they were the group actually that asked for the transparency that I described earlier, and suggested to us that we ought to divest from Whole Foods because they bought a small portion of cheese that they sell from a company that used private prison labor, which is a particular focus of their concerns with regard to how the endowment was invested. Our response to that was to say to them, you know, we generally think that Whole Foods is a really good company and they do a lot of things right. This is clearly an area in which we agree with you and we think this is important, and we would encourage you to use this as a way to learn about advocacy with companies. So we want to work with you to work with the investment manager to approach Whole Foods to take this issue on. So that not only is working so that we're consistent with the principles in our investment policy, but also consistent with our mission as an academic institution, and an opportunity to teach students about how to make a difference in the world about this. In the hedge fund space, I think the answer is really the same, which is to say, as you, I think there's the two parts of these. One is that we think it's appropriate, as Sam suggested, to short stocks like coal stocks, and thereby take advantage of the real risks and diminution in value that we think is possible there, and to push on the hedge funds as you know, as one of their investors, and say, you know, we want you to be mindful of these issues because we think they're important. There are some hedge funds that will respond to that. Obviously, there's some that won't. But we think that you can use this as a mechanism both to be consistent with academic mission and to teach them about advocacy in the world.
Thank you. Okay. And for Sam, are there considerations that investors trying to align investment practices with mission evaluate in regard to proxy voting practices of hedge fund managers?
Yeah, I mean, I think it's important to understand the position of the hedge fund managers, you know, in terms of how they're using their proxy votes. You know, what we've found is that, you know, in the sustainable and ESG space, hedge fund managers tend to be a little more active owners than in the non-sustainable and ESG space. So, you know, what we found is they tend to be actively using their proxy votes in ways that are generally consistent with our perspective. You know, but it's really a matter of having a dialogue with the hedge fund managers, understanding, you know, how they're using their proxy votes, if they are using, and you know, what their position tends to be on issues. And you know, for instance, we use our quarterly meetings with our hedge funds to discuss issues like this, and to have them report to us, you know, what they're doing on this front.
Thank you. Okay, and this one is for all. Because hedge funds tend to underperform during rising markets, should investors focus on management of stakeholder expectations and any suggestions on how to justify periods of underperformance and the high fees associated with hedge funds?
I guess I can take that one on, and then maybe Sam can cover that as well. Obviously, it's been a question for us lately with a strong U.S. equity markets in particular. The hedge funds aren't performing as well as people would expect. I think we often point our clients who have those questions back to the late 90s when I think there were similar requests to get out of everything except for U.S. equities, and to remind them what happened afterwards. That's helpful to us. We also negotiate, and I think others negotiate with their hedge funds to reduce fees, and we've seen some movement in the last year with several of our hedge funds in an effort to reduce those fees. But other than that, we try to be as transparent as possible on the fees so that they're clear. So our clients are clear about what it is they're paying.
Yeah, I could. This is Sam. From our perspective, as a fund of hedge funds, we take advantage of many opportunities to get reduced fees from funds. Whether it's using our size as leverage, whether it's being early investors and taking advantage of share classes that have lower fees, and whether it's just simply negotiating with hedge funds to reduce fees. I will tell you that, sort of the headline number 2 and 20 that a lot of people see in the press is not really, I think, a reasonable estimate of what hedge fund fees are these days. And I can tell you from our standpoint, the fees we're paying are significantly lower. And, we use all those tools to try to get fees to a more manageable level.
Yeah, the comments I would make would be two. One is as a fiduciary, it's important to be prudent about how you do your asset allocations, and that you not get too caught up in the whim of the moment. That you have to take, I think you have to take a longer view, and that in my mind, the hedge funds are a significant and material part of that strategy. Otherwise, you get caught up in the risks of momentum investing and absolutely run the risk of increasing volatility in your portfolio. And then the other is that, again, hedge funds, I'm a bit of a contrarian, and I think that as people move away from asset classes that have underperformed, there often are opportunities there to get increased value when the market shifts. So I think that while you can moderate your position, I think that hedge funds are an absolutely essential part of portfolio construction.
Thank you. And Alice, how important is customizing the portfolio to a particular client's value preferences?
I think I have a twofold answer there. It's very important for a client and for us to be aware of their value preferences and what their specific mission is. It helps them make decisions along the way as far as what are the trade-offs for investing in that particular value and maybe having less return or greater risk. So it's very important to be aware of it, to put it in writing, to put it in the IPS. That said, if you have a client, for example, that's interested only in sustainable food systems, it's not possible to only invest in companies that are aligned with sustainable food systems and have a diversified portfolio. So we want to look at other types of investments, other ESG investments that are aligned in the general value. I think sometimes we call them not misaligned or not totally aligned, but in the same ballpark. And so it's important to keep those in mind, particularly with people who have smaller endowments, investors who have smaller endowments and invest through commingled products. They have less control than you would over a separate account. So at that point, it becomes important to look at commingled funds that are employing ESG analytics in their investing, and that may hit on some of the value and may do more than that. So that's worked out well for some of our clients. We find that when they do those broad ESG investments, that often when a student or stakeholder comes to them with a concern, they find that they're not invested in those questionable stocks in their portfolio because they took that broad approach in the first place.
Great, thank you. And Sam, what are some of the practical challenges of incorporating ESG and sustainability into the investment and monitoring process?
There are a couple. I think one thing I would say is the oversight, making sure there's a consistency between what managers are saying and what they're actually doing in the portfolio. The way we get around that is, we actually get transparency from our managers into the underlying positions, and so we can take a look at what's actually in the portfolios. We'll use some third-party systems like an MSCI to look at the portfolio on a variety of ESG metrics, and we'll do our own work to actually look at the names in the portfolio to understand what they're doing and to make sure there's a consistency, from a sustainability and ESG standpoint between, what managers tell you they're going to do and what actually ends up in the portfolio. The second thing I would say is, the reporting aspect. People who invest in these strategies want some type of reporting mechanism to understand the impact of their investment. And that's always a challenge. The way, we have gone about resolving that, there are a couple of ways, but I think one of the critical ones is, we have really taken a look at the UN Sustainable Development Goals. And what we do is we map all of the holdings in our underlying portfolio to the UN Sustainable Development Goals. So we can report to investors, for instance, 10% of the portfolio by underlying name is seeking to solve, Sustainable Development Goal 7, which is affordable and clean energy. 10% of the portfolio is focused on Sustainable Development Goal 3, which is good health and well-being. So the reporting is challenging, and that's really one of the ways that that we've dealt with it.
Thank you. Alice, do you have anything to add to that?
Sure. On that specific question, what I would say, we've started to do some impact reports for our clients. So, and I think it's a similar approach to Sam in that we reach out to the managers. We say these are the broad investment themes that this foundation, for example, is trying to impact. And then we ask them to sort of say what part of your portfolio aligns with this and give an example of that. We've also worked with clients who are more focused on the divestment and done an exposure analysis on a quarterly basis to see what exposure, if any, they have to stocks on the Carbon Underground list and to list those out both by manager and individual stocks.
Thank you. And David, what are investment committees looking for in terms of reporting on ESG?
I think there's two parts to the question. One is on the impact side, which I don't think the question is about. The other is really looking at the environmental sustainability and governance issues. We look at that holistically. Because we manage at the manager level, we tend to focus on managers who align with us philosophically and who tend, as a result, to utilize ESG principles. Getting, I'm going to call it alignment, is relatively easy. Getting complete agreement is harder. So we really try to look at the issues that are up in our community and also in the community in college. So those tend to be the ones on which we focus. The obvious one that's been front and center there's two that have been front and center recently are issues with regard to institutional racism and issues with regard to climate change. So those have been ones on which we focus. I personally am very concerned about transparency and governance because I think that that's a place where there's a lot of latent risk. And I think that there's opportunities, particularly for not-for-profits, to lead by example in that regard. So it's fairly holistic, and it really is sort of, it can show up in a particular issue in either a manager or a company, but again, I think it sort of depends on the size of your endowment. If you've got enough that you're doing separate accounts, it's easier to deal on a company-specific basis. But when you're doing it like us, as a relatively small endowment, we really focus on the managers and understand how they think about these kind of issues so that we try to stay as aligned as possible with our own, I'll call it guiding principles. We have an ESG, an overtly ESG policy, but really the guiding principles for us and the issues that matter for us are the ones on which we focus with our managers.
Great, thank you. And Sam, have you seen long-short funds that do quant ESG strategies?
We're seeing some emerging funds that are incorporating some quant ESG factors. I mean, as many of you on the call know, the quantitative investing is really taking off pretty significantly, and I think people are always looking for new factors that they can incorporate into their analysis. And ESG is a factor that many people haven't incorporated, and so we're definitely seeing a new breed of funds begin to incorporate some ESG factors. And I would say it's really just beginning to emerge.
Thank you. And Alice, does the global political climate affect your thinking around volatility and risk? And if so, how would you approach that? How would you factor that into a sustainable investing approach?
Sure. At Buchholz, we tend to be what we call strategic investors and not change a lot due to the political climate. The reason for that is it's often hard to know exactly when to enter and exit, to get both of those right and to do it with a committee. So we do have ranges around every asset class as far as allocation, and so we may sway to the high side of that range or low side of that range in a certain environment, but we don't drastically change asset allocation, which is the main driver of the return. So obviously the political climate comes into question as we talk with our managers on a at least quarterly basis, talk about what they're seeing and where they're seeing the opportunities and the risks. As far as factoring that into a sustainable investment approach, I think the answer is largely the same as far as asset allocation being more driven by the characteristics of the client than by the political climate. But I would say that, again, we look at our managers there and we speak with them about what they're seeing. I think our thoughts are, from what we're hearing from managers right now, is that despite challenges right now for strategies that benefit from mitigating climate risk, there's a lot already underway that companies are doing just because it's economically makes sense. So companies are already reducing improving their energy efficiency. Many companies are moving to be carbon neutral by a certain time. I don't think that momentum will change.
Thank you. Sam or David, do you have anything to add?
Sure. This is Sam. I would just say that, from our perspective, the policy uncertainty and volatility, as I was talking about in the presentation earlier, has actually been very favorable for these strategies. I think a lot of people thought that the new administration might be unfriendly to many of these strategies, but to Alice's point, a lot of these technologies are very economically viable, and nothing's going to change that. And, from an investment environment, the volatility and uncertainty has led to a lot of dispersion, and it's been very favorable. And in fact, if we look at the last 3 or 4 months from a value added or alpha standpoint, they have been the best we've seen in a couple of years, really, for our strategies.
We take a long view about how we invest. The shifts and changes that are happening in Washington, in our view, are in some ways at the margin. I recognize that may sound a little strange, but it's pretty clear to me that while there may be political resistance to it, that there are some major forces in the world that are moving in the direction of supporting sustainability as an approach. One of the ones that to me reflected the sea change was that the cover story in Barron's in October of last year that talked about doing right while making money, and as the headline, as the cover story in the magazine, and talking about ESG investing as looking for the best ESG managers. The punchline of the story was simple. It was that those managers don't view themselves as ESG investors. Rather, they view ESG as a screen to find better investments, and that looking at sustainability, looking at good governance practices, looking at being responsible with your employees and other constituencies that involve your companies are ways to de-risk your portfolio and outperform. And that to me was a fascinating moment where the world seemed to shift for me as an investor. That this is a place where the world is saying, regardless of what's going on short term, this is what's going to drive people's decisions about investment. And as a result, it just makes sense to me. It just resonates at a very fundamental level.
Great. And Sam, you mentioned MSCI ESG metrics and UN Sustainable Development Goals. Are there any useful research papers or other resources that provide various positive and/or negative ESG and sustainable criteria to incorporate into a due diligence review?
Well, there are an increasing number of places to get data. I mentioned MSCI. There's other data providers like Sustainalytics. Bloomberg is beginning to provide more information, and in fact, even companies are beginning to provide increasing amounts of information related to sustainability and ESG. So the amount of information that's available is growing exponentially. And the challenge is really to figure out the relevance and the relative importance of the different information. But there's a lot more information out there right now.
Thank you. And last question, what are the common ESG company traits, positive or negative, that have the most impact on long-term performance?
This is Sam. Well, if you look at many of the studies, governance is probably the one that comes to the top of the list in terms of having a direct impact on performance. Some other things are that companies that are actually on a positive trajectory in terms of improving their ESG performance tend to do better than ones that are just static. So it's the positive trajectory, it's governance, but really it's on a company by company basis. That Harvard Business School study indicated that it's really about materiality. What is material? And the ESG component that is material to one company is going to be different than what's material to another company. And so I think it's really about understanding, what is material to each individual company.
Thank you. I think we have time for one more. This is directed towards Alice. Would a client consider a daily liquid ESG compliant fund with a lower volatility and correlation in the first part of their portfolio, for example, in the domestic large cap sleeve, or is ESG related to last part or niche sleeves?
Thanks, Jackie. I'm just going to put in a plug for one thing in response to Sam's answer, which I thought was very good, but there is something called the Sustainable Accounting Standards Board. It's SASB.org. If you're curious about what's material, they've reviewed and mapped every industry. They're trying to get disclosure around those items, but they've done quite a bit of studies and regression analysis about what has been material by industry. And so in answer to the question, our clients would consider a daily liquid ESG compliant fund as a first part of their portfolio, as I understand it from this question. So generally what we try to do, for example, in the equity, since this is focused on equity, is we try to construct it with similar guidelines as the way we do for all our clients. So for all of our clients, we have a passive piece and an active piece, and we use those active pieces as complements to each other. So we've been able to do that with what's available on broad ESG daily liquid funds to provide both some passive exposure and some active exposure, and to make those complementary, the active exposures complementary to each other. So very possible to do it in what you would consider the first part of the portfolio.
Great, thank you. And if we didn't get to your questions, please send me an email, and we will try to get back to you as soon as possible. And thank you all very much, and thanks to everyone that participated in the webinar. A few upcoming events that we have are on March 15th. research findings for mission-aligned investing, leadership, and the decision-making process. And one that will be later in March is on intelligent connecting energy and environment for the smart investor. And thank you again to all the panelists. If you are interested in learning more about joining or supporting the network, please send me an email or visit our website, www.intentionalendowments.org. And we also encourage you to stay connected with us by signing up for our listserv. Thank you, everyone.